Hello, I am John Najarian, and RebelCon 2022 is almost here. We do have a virtual pass. The virtual pass gives you full access to everything, all the streams, the live trading sessions, all of our fabulous keynote speakers. So to learn more about what's going on at RebelCon 2022, whether you're in person or virtual, check out marketrebellion.com/Dallas.
Hey, welcome back, Market Rebels, and happy Monday, everyone. Well, we got a nice little bounce today, what's called a Maribozu candle. We opened at the low, just been climbing higher. I don't know if we actually closed right at the high, but it was pretty close. Looked like it was about 0.75%. But we're still about 12 points or so away from the 50-day move, from the 100-day moving average. So that's going to be our next hurdle to cross. But at least it's looking encouraging compared to last week. Now, a couple of housekeeping items for this week. Normally, we do trading tune-up Monday, Thursday, Friday at 4 p.m. right on the closing bell. But we have RebelCon this week, and I know I'm going to get to see a lot of you out there excited for that in Texas, Dallas, Texas. So we will not have trading tune-up on Thursday or Friday. We also will not have cocktail hour on Friday. And for those of you in Q&A, we will not have it on Thursday. We will have it tomorrow on Tuesday. So I hope that many of you are going to be making it out to RebelCon. It's a tremendously fun time, and if you've never been, I'm really looking forward to meeting you. So for today, we're going to talk about, this one's going to be a little bit quicker than normal, but it's also one of the more powerful, and it's about time decay in a way that you can, little kind of a trader's trick that you can use to monitor your theta. Let me get this out of the way there. So we're going to look at a way that you can use delta in what's called 7-day theta. Now, before I get started, let's ask a really intriguing question. Is theta a risk? And a lot of people say it is. And then unfortunately, they go down a wrong path of creating all of their strategies about hedging theta, or they want to do nothing but sell options so they can get positive theta. And those are unfortunately bad misperceptions. So is time decay a risk? So first thing is to remember that risk equals uncertainty, right? Things that we don't know. But if you think about the characteristics of time, it moves in the same direction at the same speed. So the passage of time is 100% known. There's no mystery about it. So the better way to approach it is to realize that time decay is a characteristic of an option. You really shouldn't think of it as a risk. And again, it's because it's 100% known. We know with 100% certainty in 30 days that 30 days will have passed. We know at expiration that all of the extrinsic value comes out of an option. It's completely known. In fact, it's some of the fewest things that we know in the market with 100% certainty. So it's really a bad mistake to say, I want to hedge something that's certain. Those aren't the things to hedge in a portfolio. So confusing a characteristic as a risk is, in fact, a risk in itself. So that's the first thing. I just want to show you how to monitor it, but I'm not doing it to make people fearful and think that it's a risk, but it's still something important to know. So how can we use delta and theta to monitor decay? We're going to do some more in-depth trading tune-ups on some of the Greeks coming up here soon. But for right now, I think most of you know delta. I'll give you a quick description of it. But what you're going to do is to calculate what is called a 7-day theta. And really all that is to take the current theta that your broker's platform is showing you and multiply it by 7. Is it going to be a perfect measure in 7 days? Absolutely not. Technically, even a 1-day theta isn't a perfect measure. And that's because this is all derived from calculus and they are really, really, really close approximations. But there are small errors because you're trying to measure a curve. You're trying to make a straight line out of a curve. So they're not perfect, but they're really, really close. But when you multiply it out by 7 days, you can compound the errors a little bit. But it's still going to be a very useful calculation. So once you have this 7-day theta, you're going to divide by delta, which of course you can get from your broker's platform as well. And what that does is it shows the required stock move to offset the time decay. So again, this is a nice little trader's trick, and there's a lot of different uses. You could be just your own intuition. I don't think the stock's going to move this much in 7 days, or we could look at it according to a pricing model. There's a lot of different things we could do to see if it looks like we're at least on track to potentially make up this time decay. So let's take a look at an example. Here is a pricing model. I got this from the OIC's website, the Option Industry Council. So we have the stock at 100. We have a strike of 105. We've got 30 days to expiration, volatility of 30. None of this really matters. You could use any strike or any volatility. It's just a calculation. And we're going to look over here, and the pricing model tells us that this option would be worth about $1.56, 57, somewhere in there, and it has a delta of 30. So that's exactly why I chose these numbers over here, so we could get a nice even delta. Our gamma is about 4, but there's our theta, 0.0498, so roughly 5. So for those of you who don't know, what this means roughly is that if you bought this option right now, or maybe you're currently holding it, it's worth $1.56. If 1 day passes, all else being equal, so our volatility stays the same, stock price stays the same, this option is going to lose about 5 cents. It'll be trading for about $1.51. And in fact, if this were a live pricing model, I could make this days to expiration 29, and you would see that this would go to $1.51. That's all that theta is showing you. Now, the delta is showing you the approximate sensitivity of the options price relative to the stock price. So you can think of delta as a percentage. So if the stock moves up $1 right now, this option is going to pick up 30% of that, or 30 cents. So we know that the option would be trading for about $1.86. If the stock moves up 10 cents, we would expect to move up 30% of that, or 3 cents. This would go to about, let's call it about $1.60. It's just 30% of whatever that stock price move is. Now, this is also assuming that we're talking about a fairly small stock price move, not $20, because now you're going to definitely involve some compounding errors. But for a small move, delta is pretty accurate. So again, we're looking at this information on our broker's platform, and we're trying to figure out if we are going to kind of survive this 7-day time decay. So here's what we're going to do. We're going to take the options price and the theta, and we're just going to multiply those out. So I've got roughly 5 cents per day times 7 days, which is 35 cents. But remember, we're not going to pick up dollar for dollar. For this example, we're picking up 30% of that. So now I'm going to take that delta. I'm going to take 35 cents divided by my delta gives me $1.16. And what that means is that how much of a stock price move do I need to make up for this time decay over 7 days? So what this is telling me, I need this stock to move up about $1.16 in order to keep this options to make up that 35 cents. So that should keep my price about the same. So let's put it to the test. Our option right now is worth $1.56, maybe $1.57. What are we going to do? Let's increase the stock price $1.16. That's what we just figured out in the previous calculation. All right, so that's that. And now notice I've also taken the time to expiration down to 23 days, because remember, this is 7-day theta. So we're assuming that 7 days have passed. I'm keeping all other factors the same strike, same volatility. So what do you suppose that the options price should be? Well, let's go check it out. And there it is, $1.55, pretty close. Now remember, I did say there would be some errors, but you can see it gets you pretty close. So now we at least have a measuring stick. We can say, instead of being surprised at the end of the week and going, oh my gosh, my options bled out a lot, we have a pretty good idea of saying, does this seem reasonable to me? Do I think that this stock can move $1.16 in the next 7 days to offset this theta? And there are more fancy ways. We could look at some of the calculations and looking at volatility. But for right now, you can at least use it as an intuitive idea. You can just say, yeah, I think that looks pretty reasonable, and I'm willing to take that bet, so to speak. But this will give you a nice little measuring tool, and it's definitely something that a lot of the professional traders know. So I thought it would be helpful for the group. So the idea is to monitor your decay. Use delta and 7-day theta to monitor the rate of decay. It allows you to see if the stock price movement is sufficient to offset the options time decay. Now, by sufficient, of course, this means that is it at least within the realm of expectations, or what we would think is a reasonable move. And so that's a nice little tool that you can use. And there is no right or wrong answer on what you can do. Some people might close the position. Some people might sell options against it, roll it. There's all kinds of things. But at least you have a reason for making a decision. Okay, so that's the main thing. It gives you a method for coming up with reasons for your hedges, rolls, and morphs. So I hope that helps. The main thing, like I always like to point out, is that it's really to show that you need an understanding of options, more than just saying, I understand what a vertical spread is or a butterfly. Those are the basics. But if you really want to succeed, you have to understand the trader's tools, what makes an option tick, your option theory, your synthetics, your hedges, rolls, morphs, and little tips like this, and it will make your trading so much easier. So for anyone who would like to go to that next level, we're making you a free offer here. You can never beat a free offer. Phone number is 888-809-8058. And that is to get a free consultation with one of our professional coaches. I always mention that many of these have decades of floor trading experience from exchanges. So if you want to know the people who know their options in theory stone cold, it's these people. And you can chat with them. Call them up. You can get a free 30-minute one-on-one consultation. So that's really for people who want to take this serious and take it to the next level. So give that number a call. It's again 888-809-8058. I hope that helps. And I'm also looking forward to seeing all of you who will be in Dallas on Wednesday. And we'll see you then. Thanks so much, everyone. We'll see you next week.